Hey folks, this is Hasan, a tutor of Advanced Audit Assurance. So here it is a triple A final revision, or you can say grand revision. Right, we are starting with the money laundering. Uh, so what is money laundering? Okay, money laundering, the process by which criminals attempt to conceal the true origin. Okay, what is it? Conceal true origin. True origin and ownerships of the proceeds of what criminal activity, allowing them to control over the proceeds and ultimately providing a legitimate cover. Okay, legitimate cover over their sources of income. Right? What are the examples of it? What are the examples of it? The possessing in any way dealing with concealing. For example, the money earned through the robbery, money earned through the fraud. That's all come under the umbrella of money laundering. So the proceeds of any crime, criminal property also includes attempt or conspiracy or incitement to commit such an offense, aiding, abetting, counseling, or procuring the commission of such an offense. Okay. Criminal property also includes what? Tax evasion, bribery, and corruption, benefits obtained or income received through the operation of a criminal cartel. Okay, so far so good. Now, what is well? I hope money laundering is clear to you guys. Now, what is FATF? It is Financial Task Force on Money Laundering, known as FNA. FATF, the group, the detection, franchise, or balancement is an intergovernment body which sets standards and develops and promotes policies to combat money laundering and terrorist financing. FATF recommends, sets out the comprehensive, consistent framework of measures that countries should implement to combat money laundering and terrorist financing. Okay. So, as far as the anti-money laundering guidance, the sector has been prepared jointly by the Consultative Committee of Accountancy Bodies for anyone who provides audit, consultancy, tax advisory, insolvency, or trust and company services in UK. This is issued by ACCF technical fact sheets. So it includes the scope of the money laundering. The failure to comply with detailed provisions should have serious legal, regulatory, or professional disciplinary consequences. Okay. There is no definition of suspicion, though professional judgment must be exercised to meet reporting requirements. Okay. Now, what are the principal offenses? What are the principal offenses of money laundering? Well, I hope you all remember till now. That is, yeah, laundering, failure to report, FTR means failure to report suspicion, and taping off. That's the principal offenses of, you know, specific offenses may also include failure to take preventive measures. Right now, what is laundering? The process of laundering criminal proceeds is often described in terms of three stages. Okay, so now, sorry for that. Once again, I have to do it. Yeah. So laundering, it has three stages. What are those three stages? Number one, the placement. Okay, the placement. Physical currency enters the financial system. For example, dirty money in the form of physical cash can be deposited at a financial institution, example, bank, to start the cleaning process, used to purchase money orders to pay off a loan or a debt, converted to tokens or gambling chips in a casino. This can be the most challenging stage for a money laundering because placing large amount of cash into a financial statement usually draws suspicion. Okay, so it is the first stage. Then we have the second stage, that is layering. Okay, layering occurs the trail of dirty money, the by way of series of financial transactions, building layers between the funds and their illegal source. For example, a series of bank-to-bank funds transfer, both domestic and international, buying and reselling high-value assets such as properties. Then we have integration. Integration with monies from legitimate commercial activities as they enter the mainstream economy. The illegal funds take on the appearance of legitimacy. At this stage, it might be impossible to determine whether wealth is legal or illegal. Okay. Now, when we have some, uh, we have to report suspicion. What we will report? Well, I hope the full name of reporting business, identification of each subject, the role of each subject. Okay. Uh, Identification or references, location of laundered property. That is what we have to report. And there is no requirement to quantify the certainty of suspicion. Okay. Now, what is tipping off? What is tipping off? Listen carefully. For example, this is the guy on which we suspect that he is involved in the money laundering. And this guy comes and inform him that, dude, they are actually suspecting you in case of money laundering. So now this is tipping off, and it will come under the umbrella of money laundering. Even this guy, if will be considered as doing a money laundering, and he will be punished as well. He can be penalized, he can be going behind the bars. Okay. Now, what are the penalties? What are the penalties? Well, of money laundering. Imprisonment can be done. There can be fines, or there can be both. So, all partners in the practice are potentially liable on a joint and several basis for the breaches of the firm's obligation. All individuals are liable in respect of breaches of their individual obligations. Okay. So, what are the additional risks? Well, additional risk can be adverse publicity. Obviously, there will be loss of reputation, and People will may not like it, and they will uh, adverse publicity will obviously ultimately lead to a fraud. Then obviously there can be a loss of reputation. There will be loss of authority to conduct business. Okay. So a report having been made to appropriate authorities intention to make report, but there was a reasonable excuse for not having done so. That action by the client or acquiring property was thought to be in good faith and for adequate consideration. Okay, so far so good. Now, what are the requirements? Well, to get safe from the money laundering, uh, the requirements on the firms and the organizations are establish top-down anti-money laundering culture, implement risk management procedures, efficient compliance with legislation, appoint a money laundering reporting officer, appoint partner responsible for risk management and internal controls, implement record keeping systems, for all transactions, obviously maintain initial verifications for continuing monitoring of clients. So maintain systems for initial verification at all stages. And it's not a one-time exercise. It should be done continuously. Okay. I hope it is clear till here. Well, now who is MLRO? Money laundering reporting officer, obviously. Okay. It is offense to not appoint MLRO Okay. MLRO should be a suitable level of seniority and experience. Furthermore, uh, the responsibility of MLRO is considering internal reports of money laundering. Decide if there enough grounds for suspicion. Prepare SARS. Okay. Uh, Train the firm employees. So these are the responsibilities of MLRO. As far as the record keeping is concerned, all client identification records and details of businesses and transactions, details of monitoring of the relationship must be maintained. Okay, records of a transaction must be kept in really retriable form or at least for 5 years. Okay, so as far as the record keeping is concerned, it should be kept for 5 years. Okay. Must have controls to ensure that where records are accessed by more than one department or individual, they cannot be destroyed until the 5 years retention period has been satisfied for all users. So far, so good. Customer due diligence. Well, what is customer due diligence? Taking steps to check customers and check they are who they say they are. So CDD, customer due diligence, also known as KYC, know your clients. Ensure that professional accountants know who their clients are. Do not accept clients unknowingly which are outside the firm's risk tolerance or whose business is not understood with sufficient clarity to be able to form money laundering suspicions when appropriate. Okay, so customer due diligence applies to all clients, must be conducted when establishing a new business relationship, when carrying out an occasional transaction, when there is a suspicion of money laundering or terrorist financing, when there are doubts concerning the accuracy and reliability of previous identification. Before entering a business relationship, the professional accountant must identify and verify client's identity using documents or information from reliable and independent source and beneficial owner who is not the client. Okay, so far so good, and I hope it is clear till here. Uh, so, as far as education is and training is concerned, well, it is how to report to MLRO, how to identify clients, record keeping, On which grounds to suspect this must be this training and education must be given to employees of the firm, right? So far, so good. And finally, a business is not obliged to continue to act for a client where it does not believe that it is commercial interest to do so would be incompatible with business or ethical requirements. Um, I hope it is clear till here. And now we are doing will be doing one of the important area, code of ethics and professional accountants. Well, uh, the purpose of code of ethics. What's the purpose? The main purpose of the professional codes are to provide professional accountants with guidance for maintaining an appropriate attitude and enhancing the accountancy profession, to give accountability to the public, to codify behavior beyond that which is in legislation. Okay. So IFAC believes that due to national differences of culture, language, legal and social systems, member bodies, example ACC, are primarily responsible for preparing detailed ethical requirements and implementing and enforcing such requirements. Okay. Uh, so we have five fundamental principles. And what are those? Number one, integrity. What is integrity means? A person should be honest and straightforward in all of his professional dealings. Then there is objectivity. What is objectivity mean? That there should be no biasness, there should be no discrimination, and no conflict of interest in all of the professional dealings. Then we have professional competence and due care. So profession and competence due care means that a person should be up to date with the skills and knowledge required. Right? For example, person cannot now move ahead with IS 17. It should be uh, updated to IFRS 16 leases. Okay. And then next is confidentiality. Confidentiality means uh, we cannot disclose our client information to third parties, but yeah, it can be disclosed when it is public interest, but for the public interest, we should consult with our lawyer, right? And yeah, required by required, it is mandatory to do so. You have no choice. Then finally, we have professional behavior. What professional behavior says, we should avoid such acts which to discredit the reputation of the profession. So I hope it is clear till here. And We have few threats to the this fundamental interest. The threats. Now, what are the threats? One is self-interest threat. What is self-interest threat? Financial interest in the company, at the client, or you have taken the loan with them, or you have a close relationship with them. A family member is working there. Uh, Someone doing employment over there. That's all self-interest threat. Then we have self-review threat. What is self-review threat? Earlier, we had providing, for example, we had providing them tax services, and now we are going for the audit. So there's a lot of chances that they will overview our work and ignore the misstatements. So that's a self-review threat. Then we have advocacy threat. What is advocacy threat? That promote our client, or we should not defend them in any legal case. Otherwise, that could be the problem. That's advocacy threat. Then we have intimidation threat. What is intimidation threat? Uh, you know, they will the client will be like, sorry, yeah, in they will deter from acting objectively. Avoid, they will threat us. For example, they said, we will kill you. They will say that we will remove you from this position in the future. Or they will say that, dude, you will be, we will not give you the fee. So that's intimidation threat. And then we have familiarity threat. Okay, what is familiarity threat? Finally, a close relationship with her or family member is working over there. For example, you went for audit and you got a call from your wife telling, do you want to be at home tonight? She said, yeah, of course, why not? He said, then don't say anything to my father. That's familiarity threat. Okay. So I hope now professional skepticism, which is one of the your skepticism is one of your professional skill as well. What is professional skepticism? Person should be alert for any situation. It should not, a person should not assume blind, honest, or dishonest. You should be alert. And what they do, they will initially on entrance, they will check you and then they will keep an eye on you. That's special skepticism. Okay. So, what are the safeguards? Safeguards to threats? Well, create the sections in firm. For example, one section for audit, one section for tax to avoid such overlooking. Okay. Don't take loan. Switch the client in case of familiarity, education and training. That's all. are the safeguards, few of the safeguards. I hope it's clear to you. So now the fee. Fee should be reasonable, up to market fee, up to market rate. Okay. Always clear and due fee and avoid contingent fee. Now, what is contingent fee? Fee which is depend on other factors such as save the money on tax and we will give you some extra income. That's contingent fee. So avoid it. Avoid self-interest threat, self advocacy threat, etc. Okay. I hope it's clear. Now, we'll be moving to ISA 250 laws and regulation. Remember, you do not need to remember the name and numbers of the standards. So, what ISA 250 says? It says that, you know, the primary, it is the duty of um, to make sure the client, the company is complying with laws and regulations. Okay. And while auditor is only responsible for the audit of financial statements, while doing the audit, if auditor finds out any non-compliance, then they should report it to the manager, to the management, and still, if the non-compliance is not fixed, then they should report it to audit committee or to top management. Still, in case of non-compliance, then it should be case of non-compliance, then it will be reported to regulators and modify the report. Which report? The audit report according. I hope it is clear till here. One of the topic and a very important topic this time is quality management. So the quality management, IAS, we developed a framework for audit equality to describe in different elements that create environment or audit quality at level of the engagement, the firm and the national body. The elements of the framework are the input factors, the processes, the outputs, the interactions, contextual. Okay. So firstly, we will have ISQM1, ISQM1. Okay. Quality management, perform audit or review of financial statements or other assurance. So what is system of quality management? System of quality management implemented and operated by a firm who provide reasonable assurance that firm fulfill its responsibilities. The report issued are appropriate in the circumstances in which it is issued. Okay. I hope it is clear to you guys. Now, what are the elements of IS 211? Firstly, governance and leadership, the relevant ethical requirements, resources, information and communication, engagement performance, acceptance and continuance, firm risk management process, monitoring and remediation. So I hope you are. So firstly, the step one is firm risk assessment process, which is applied. Okay, what is here? It is firm risk assessment process, which is applied to other seven components shown how the firm is required to implement the risk-based approach to quality management. Okay, so that is the first is identify the risk. Then at the governance and leadership. Governance and leadership establishes the environment that supports the system of quality management, quality objectives, including commitment to quality through a culture, recognizes and reinforcing the need to serve the public interest, leadership responsibility, accountability for product and organizational structure and assignment roles. Resources needs are planned for and resources are obtained. Okay, relevant ethical requirements. The SOKM should include objectives and policies to ensure that the firm and its personnel fulfill the relevant ethical requirements. Acceptance and continuance. Okay, the firm's judgment about whether to accept or continue a client relationship or specific engagement must be appropriate based on engagement performance in the partner or other individual appointed by the firm who is responsible for the audit engagement and its performance for the audit report, the team, all partners and staff performing the audit engagement, and any other individuals who perform audit procedures on the engagement, the resources, which includes human resources, the technological resources, or the intellectual resources. Okay, then information and communication, obtaining, generating, or communicating information, generally an ongoing process that involves all personnel and encompasses the dissemination of information, okay, which includes information systems, culture of the firm recognizes relevant and reliable informations, and then finally monitoring the things. the procedures overall. Okay. I hope it's clear. Now, who is EQ reviewer? The one, a partner or other individual in the firm or external individual appointing by the firm or external individual. Okay. Appointed by the firm for quality review. That's EQ reviewer. Okay. So a firm must have policies or procedures to assign responsibility for appointing EQ reviewers to one or more individuals with the competence, capabilities, appropriate authority, fulfill the responsibility, specify the eligibility criteria for appointment as an EQ reviewer. The EQ reviewer must not be a member of the engagement team and must be criteria that is competent, comply with relevant ethicals, comply with laws and regulations. No, I hope it's clear till here. Then we have audit of financial statements. Well, ISA 220 revised quality management for an audit of financial statement deals with the specific responsibilities of the auditor regarding quality management at the engagement level for an audit of financial statements, the related responsibilities of the engagement partner. Okay. So what are the components of this? Well, one is first is the same one, that is the leadership. Okay, clear, consistent, effective actions that reflect the firm's commitment to quality and establish, communicate the expected behavior of engagement team members, relevant ethical requirements. Team members, awareness of relevant ethical requirements, give the nature and circumstances of the audit engagement, the firm's related policies or procedures. Then we have acceptance and continuance. So determine that the firm policies or procedure for the acceptance and continuance have been followed and conclusion reached is appropriate. Okay, then engagement resources, using the resources assigned or made available to the engagement team appropriately, engagement performance, that is direction, supervision, and review, undertaking consultation on difficult or continuous matters, and then finally monitoring and remediation. Remaining alert throughout the audit or information that may be relevant to the firm's monitoring and remediation process and communicate such information to those responsible for it. So far, so good. And I hope it is clear till here. It is the one of the important topics for this time. Then planning, materiality, and risk. So, uh, just fast forward revision. What is audit strategy? Overall audit strategy that sets the scope, timing, and direction of the audit and helps guide the development of the detailed audit plan. Okay. The determination of appropriate materiality levels, identification of higher risk of material misstatement, identification of material components and account balances, identification of recent industry financial reporting or other relevant developments affecting the entity. So the auditor should develop an audit plan to reduce audit risk to an acceptable low level. Okay. It includes the risk assessment procedures. It includes the audit procedures required, the nature, timing, and the extent of the direction and supervision of engagement. Okay. So, so far, so good. What are the risk assessment procedures performed to obtain audit evidence, analytical procedures, inquiries, inspection, observation? That's a revision from double A. So that's why I'm not writing and just going skim through it. Okay. Understanding the entity and its environment. It's another one. Now, now, what is risk of material misstatement? Where there is a possibility of what? A misstatement occurring. It being material. If it were to occur. So ROMM exists at two levels. At what levels? At financial statement level and assertion level, if you remember, guys. Okay. So we have three type of risk. Again, this is the revision. Inherent risk. Okay. What is inherent risk? Which is start from the start from business till end. For example, risk of bad debts, obsolete inventory. Okay, that's inherent risk. Then we have control risk. Now, what is control risk? Risk that controls won't perform and loss could occur. For example, you know, there is no segregation of duties or there is no CCTV and robbery might happen due to this. So, so far, so good. Now, what is materiality? Information is material if it's omission or misstatement could affect the user of financial statement. For example, this is a liability of $5,000. Okay, if I exclude it, you might decide to invest. If I include it, you might decide, okay, it's a liability by the way. So you might decide, if I include it, you might decide not to invest. So this is material for you, right? So the materiality levels, it's 5 to 10% for profit before tax, 1 to 2% of total assets, 0.5%, 1% of revenue, 1% of revenue. So do remember it. Now, what is performance materiality? For example, uh, I set this materiality 5,000. Okay. Now I have various boys such as this fixed asset boy, the revenue boy, the liability girl, uh, expenses girl. Okay. So all came to me, asked me, what's the material? I said the materiality level for this time is 5,000. Okay. They said, okay. They went for audit. They came back and I asked them, what are the misstatements? So the fixed asset boy said, it's 3,000. The revenue boy said, it's the misstatement of 2,500. The liability girl said, it's a misstatement of 4,000. The expenses girl said, it's a misstatement of 1,000. So separately, to look at them, is it material? No. But when we will aggregate them, but when we will aggregate them, it's 3,000, it's 2,500, it's 4,000, it's 1,000. How much are they? It's 356. 3,000, 5,500, 5,500 plus 4,000, it's 9,000, and it's more than 10,000. It's 10,500 in the total. Whoa. So that means the performance materiality is to set the materiality level below the setting materiality below materiality level. So that's performance materiality. And so that even in aggregate, it could not cross the materiality level. Right? I hope you guys got it. So When you will get ROMM requirement, it's when you get ROMM requirement, it's all about financial statement risk. Either it is inherent risk or control risk. Okay. Uh, it's in financial statement risk mostly, right? Including inherent risk and control risk. But uh, now, what's the audit risk? Now, it's include inherent risk, it includes control risk, plus it includes detection risk as well. Okay, and so what are the detection risks you may get in your question, in your exam questions? It's regarding it's a new client. There could be a opening balances issue. There could be, listed client, family oriented business. Then there will be a detection risk, and it's obviously will be an audit risk required, right? So I hope it is clear till here. Then finally, we have business risk. Now, in business risk, we have various risks. That is one is strategic risks. Risk that an entity is unable to achieve one or more of its strategic objectives. This may be due to poor selection of strategic options, poor management, execution, and other factors. Then we have reputation risk. The risk that negatively publicity regarding an institution business, its procedures, policies, practices, actions, ethics, actions of its stakeholder, for example, directors, managers, employees, regulators. Environment risk. Environment risk, the actual or potential and threats of adverse effects of living organisms and the environment by the influence, emissions, waste, resources, depletion, etc. The potential effect that the environment may have on an entity. Then process risk is another example. And internal risk, which arises in business processes, are poorly defined and not properly aligned with business strategies, do not perform effectively or efficiently to meet the entity's objective, do not add value to the entity. Then we have information risk. Information risk that external and internal information used for decision making results in inappropriate decisions being made. This may result in damage to the entity and its stakeholders. The risk encompasses inappropriate information being made available to an entity's stakeholders. So far, so good, and I hope it's clear till you guys. Uh, now, Next is audit reports. So ISA 700 forming an opinion reporting on financial statement deals with the auditor's responsibility to form an opinion on the financial statement, the form and contents of the auditor's report. The objects of the audit report are to form an opinion on the financial statement based on an evaluation of the conclusion drawn from the audit of evidence to express clearly opinion through a written report. Okay. So these are the objectives. Now, to form an report, to form an opinion, auditor of financial statement must include sufficient appropriate audit evidence, uncorrected misstatements, according to reporting framework, accounting estimates are reasonable, terminology used is appropriate, so far so good. Now, what are the types of misstatements? So, factual misstatements about which there is no doubt, for example, error or omission in reporting an amount or disclosure. They could be judgmental misstatement. What is a judgmental misstatement? Misstatement arise from management judgments concerning accounting estimates that the auditor considers unreasonable or the selection or application of accounting policies that auditor considers are inappropriate. For example, when determining fair value of non-current assets, the level of disclosure for a contingent liability, projected misstatements, the auditor's best estimate of misstatements in population based on the projections of errors identified in audit samples. Now, what are the elements of the report? Elements of report. Okay, that is title. For example, independence audit report, addressee, for example, shareholders to the shareholder of XYZ company, Then there will be the auditor opinion. Then basis for opinion, on which basis is the report is been given. Going concern paragraph, if there is any. Okay. Key audit matters. Remember that key audit matters will be in case of listed companies only. Okay. Key audit matters. See, I'm highlighting it. Key audit matters will be in case of listed company only. Okay. So then there will be other information that is the director's report, CEO report, etc. So management responsibilities paragraph, auditor's responsibility paragraph, name of engagement partner, name of auditor's address and signature, and then date of auditor's report. So I hope the opinion section is only one section of the report and may be unmodified or the modified opinion. Okay. The report may include additional communication such as key audit matters, material uncertainty, going concern section, and it will come if there is any, indications or going concern issues are there. In phases of matter paragraph or other matter paragraph as well. Then reasonable assurance, auditor provides a high but not absolute level of assurance and express the material misstatement to provide reasonable assurance. The auditor assesses the evidence collected in respect of the financial statement as a whole, expresses a conclusion thereon. All right, that the term true and fair is not defined in ISA's definition, should therefore be regarded with caution. So, okay. Now, key audit matters. Key audit matters in which the auditor's professional judgment were of the most significant in the audit of financial statement period. They are selected from matters communicated to those charged with governance. Okay. So remember, it is for listed companies only. These are the matters which are most significant in view of auditor. So this should be one which are most significant in terms of either qualitative and quantitative. This could be most complex. Okay. And most I assess risk of material mistake. These are the matters which will come under the CAMS key audit matters. I hope it is clear to you guys. And so far, so good. Now, firstly, we have unmodified opinion. Unmodified opinions comes under ISA 700. Okay, that is very the simple one in which if they are free from material misstatements. Then we have modified opinions. So modified opinions. Okay, one are modified opinions in which there is some material misstatement at certain level. Okay, at certain level, and other area is free from material misstatements. So in this, we will say to the while providing the opinion that at this inventory is materially misstated, etc., and other is free from material misstatements. That is modified. So unmodified opinion is also known as unqualified. Okay. So for qualified opinion or modified opinions, misstatements individually or in aggregate, impact of insufficient appropriate evidence on which to base an opinion is material but not pervasive. Okay. Then we have disclaimer of opinion. Disclaimer of opinion, unable to obtain sufficient appropriate audit evidence on which to base an opinion to conclusion reached to the possible effects of undetected. And there is finally the adverse opinion, having obtained sufficient appropriate evidence, conclusion reaches that misstatement individually or in aggregate are both material and pervasive. So here it's material and it's pervasive. Okay. I hope it is clear till here. So I hope then sustainability reporting. Sustainability reporting is means by which companies and other organizations communicate their performance and environment, social governance impacts, greater transparency about the risk and opportunities faced by an organization, give stakeholders more insight into performance beyond the bottom line. Okay. Uh, so far, so good. So IAASB currently ISAE 3000 assurance engagement other than audit or review of historical financial information provides important basis for performing assurance engagement on the social, environmental or sustainability information. There are many challenges to providing assurance in these areas. Okay. So what are the sustainable matters? Environmental, social, economical, cultural matters, including the impacts on the entity activities, products, and services on the environment, society, economy, or the culture, or the impacts of the entity, other entities, policies, performance plans, goals, governance relating to such matters. These are the sustainability matters. Okay, so generally, sustainability reporting frameworks are comprehensive and cover a broad range of sustainability topics such as global reporting initiative standards, force on climate related financial disclosures, OECD guidelines for multinational enterprises. Sustainable information includes climate, including energy, water and effluents, biodiversity, labor practices, customer health and safety, economic impact. So before accepting, the matters to be considered before accepting an engagement to report on social, environmental, or sustainable matters have obvious parallels with the matters to be considered before accepting an audit relevant ethical requirements, including independence, appropriate competence, and capabilities of engagement team, including sufficient time. Preconditions for an assurance engagement are present. A common understanding between the practitioner and the client of the terms of the engagement, including the practitioner's reporting responsibilities. So, for sustainability information, level of insurance, level of assurance is limited. Okay. For example, on disclosures related to social topic and reasonable assurance on disclosures related to environmental topic needed to provide limited assurance on disclosures about risk related to the social topic, reasonable assurance on the process to prepare the disclosures related to social topic, existence of suitable criteria, how they were selected or developed, the sustainability information within the scope of the assurance report is not all of the sustainability information. Other matters, for example, event transactions, conditions, and practices that may have a significant effect on the assurance engagement. Okay, that need to be given. Now, what are the potential risk areas? Risk of non-compliance, risk of compliance cost rising, provision, contingent liabilities, non-current asset values, example, property near contaminated site, uh, product redesign cost. So these are some examples. Which standards will apply here? Accounting standards, IFRS, which will apply in the sustainability matters are IS 8, IS 10, IS 12, IS 16, IS 20, IS 36, 37, IS 38, IFRS 3. These are the standards which can be come in this sustainability questions or in the, in this area. So now what could be the measurement issues? Well, many listed companies report ECG impacts either as part of annual report or separate report. One of the key challenges is reporting sustainability information is finding suitable environmental, social, uh, ESGs, key performance indicators. So finding KPIs are challenging. Okay. Measurement of environmental effect, for example, often requires some form of conversion methodology or estimation emissions resulting from the consumption of oil. Contrast, there may be no established model for measuring social impacts, such as those relating to poverty. This is the list of potential indicators. Now, what are what can be the indicators, for energy? It could be, energy consumption, energy save. For water, it's water consumption, percentage of water reused or recycled. Supply chain, supply chain miles, percentage of suppliers complying with sustainability strategy. So far, so good. And I hope it's all clear to you. Right. Then, for the procedures, remember to start with verb and then tell why you are doing that, right? For example, review the board minutes to confirm the approval of expenditure. See what I did. Review, that's a verb. The board minutes to confirm the now the after that what I'm doing, I'm giving the reason. Review the board minutes to confirm the approval of expenditure. That's the reason. If you not tell that why you are doing it, you won't get the mark. So that's how you should be doing. Okay. And remember, connected with the scenario. Connected with the scenario. If you know you won't get the marks. Then in case of the evidences, remember that evidences are tangible. For example, for example, re- the working papers to confirm recalculation is performed. Now see, working papers to confirm recalculations is performed or not. Right, so see, working papers, review. That's how it is doing. It will be always tangible. It will always be, uh, and the rest is saying. So that's how that this should be done. And I hope a last minute revision session. If you guys have any questions regarding the anything, you still have the time. You can ask me on my WhatsApp. And good luck. So far, so good. Bye bye.